From New York City, for our viewers worldwide, I'm Matt Miller in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, consumer demand remaining strong while inflation starts to moderate, fueling hopes that the Fed could shift to smaller rate hikes come September. Bringing some respite to beaten down credit markets, we begin with the big issue, wrapping up a messy month for the markets.
The pain felt in fixed income.
The losses this year have been the biggest on record.
After a really, really tough 6 to 12 months.
The bond volatility has really declined in the last few weeks.
Starting to see some value being restored in the fixed income world.
Bonds have repriced sufficiently.
This is a time where you want to embrace bonds.
There's a lot of good things happening. There's a lot of bad things happening.
You have to accept it's a down year.
Recession is coming at some point, and the Fed needs some room.
The growth risks are growing. The inflation risks are maybe peaking.
What happens in a leveraged system when the Fed is super aggressive?
The Fed is going to have to slow a little bit.
It's really dependent on what the Fed actually does.
Joining us now, Goldman's Amanda Lynam, BlackRock's Marilyn Watson, and Troy Gayeski of FS Investment Solutions. So it looks like, or it feels like, we have reached some kind of turning point. Certainly in equities, we had 7 weeks in a row of losses, the longest string of weekly losses since 2001. And this week, we're finally going to recover. In terms of fixed income, really the Fed minutes seem like the turning point. I wonder what you think of that. And Amanda, we'll start with you. Is it possible to read the Fed minutes in a dovish way? And is that what we think markets have done?
Oh, sure. Thanks, Matt, for having me. I mean, certainly those minutes were consistent with our economist baseline view that after 2 more 50 basis point rate hikes, the pace will turn to a 25 basis point rate hike after that through the middle of next year, ultimately ending at a terminal rate of 3 to 3.25. And so I really think it's a combination of things. In addition to perhaps some signaling on the monetary policy side, I also think it's a recognition by investors that valuations have reset substantially across the credit market. As we noted last night, 65% of high yield bonds are trading down 10 points or more versus the start of the year. Of course, a lot of that is driven by the rate move, but it really has introduced a lot of upside convexity into the credit market. Similar pattern is playing out in IG. And so I think that, coupled with perhaps some encouraging data points at the idiosyncratic level this week from the retail sector, for example, have emboldened investors, I think, to ramp up the risk appetite a bit, which is why you're seeing some of the tightening at the index level. That being said, we still think that an up in quality stance makes sense here. Our economists are expecting growth to continue to decelerate through the end of this year. And so we think that investors will start to focus more on quality and those companies that can really manage through a perfect storm of headwinds well.
Yeah, I'll just point out to viewers using a terminal, if you type IN-GO, you can see the indexes and everywhere from global aggregate, treasuries, credit, I mean, all the way down, it's double-digit losses year to date. Marilyn, do you think that we've seen the peak in yields this week?
I don't necessarily think that we've seen the peak in yields. I think what we have seen over the past several weeks is the market has been trying to digest a huge amount of information and uncertainty. So obviously we have the extremely high inflation rates globally. We have central banks who are now starting to normalize, and we're not just looking at the Fed now, we're also looking at comments from the ECB and the strong likelihood that they're going to start to actually raise rates as well, very, very soon as well. And then we're also looking at the market really trying to sort of gauge the probability of a slowdown in growth, partly because of central bank policy, partly because of the cost and the impact of the war in Ukraine, of sanctions, of the zero COVID policy in China. So I just think we're seeing so much that the market is trying to digest. I think that the Fed minutes did give the market some comfort that they were, relatively hawkish, but were sending a pretty consistent message with what the market is already pricing in, maybe 2 more 50 basis point hikes, and then from there maybe sort of slow down a little bit and be more data dependent. But I just think at the moment we could see yields a little bit higher, but I think the market's starting to stabilize and is beginning to really digest all of this news it's been bombarded with.
Yeah, it does seem that the market's pricing in fewer hikes, or let's say fewer 50 basis point hikes now. Troy, what's your take?
Yeah, so look, basically inflation expectations started to roll over several weeks ago. And as yields peaked, at least locally, again, I think the jury's still out on whether a 2.7% 10-year is sustainable in an inflationary environment that we're still going to be in for several years. But as yields peaked out, right, you were setting the stage for a bear market rally, which we're getting right now in equities. And look, the unfortunate thing for fixed income investors is if yields have peaked out, you're still receiving a very paltry amount of income with a tremendous amount of duration. So if inflation does stay more sustained, you could have another big run up in yields, not by 100 or 200 basis points, but certainly 50 to 75. And so in an environment like this, if you can find stable NAV products that have mid to low high single digit returns, you should chase that like an oasis in the desert, because the yields that are out there today still are too low for clients to achieve a lot of their asset allocation goals.
I mean, do you expect inflation to be sustained? President Biden out with a statement on the April data saying that the decline in inflation is a sign of progress, even as we have more work to do. He says it's my top economic priority. And when you have not only the White House working on this, but the Fed working on it, as well as base effects coming into play, do we, Troy, see inflation sustained at these levels?
Oh, no. So inflation has certainly peaked, or we think it's a high probability that it's peaked. It's just a question of how fast it comes down, right? And clearly the supply shocks with China's bizarre COVID-0 policy and the Russian invasion of Ukraine have exacerbated that. And, you know, the concern is that once you get inflation embedded in the labor market, which we've had 5 more months for that to happen, you know, you can stay at a above 4% level for far longer than even we thought, you know, several months ago. And so no one's calling for a Zimbabwe-style inflationary outcome. It's just if yields have peaked, you're still earning a paltry yield. And if inflation sticks around for a bit longer than markets are pricing in today, particularly at the back end of yield curves, there could be more mark-to-market pain there. And again, there's still a lot of elevated duration in markets.
Amanda, what do you think? I mean, is the end of May and the beginning of the summer, is Memorial Day weekend going to mark a turning point, a bigger turning point for markets?
Well, certainly, we do think that our economists' view is that inflation will start to moderate as the year progresses. I think what's key for credit investors is really the importance of individual issuer selection in this environment. What we've seen is that the pressure on the bottom line in terms of margins and managing these various inflationary costs like labor, freight, transportation, just regular raw materials, it's been indiscriminate across the quality spectrum. And so we've had IG bellwethers really miss consensus earnings due to that margin pressure, just like some of their high yield peers have. And so I think moving forward, even if we do experience a moderation in inflation, what's really going to be important for performance is picking those companies that will have the success to manage through that. And we're seeing significant dispersion, not just across the market, but also within sectors, just dependent upon where these companies are focused, who their target customers are, how many suppliers they have. And so it really has picked up intraday volatility in the credit market, as well as dispersion, which is all very consistent with our expectation heading into it.
Marilyn, how do you BlackRock clients deal with that?
Yes, I think that inflation has probably peaked and is starting to come down and will moderate. That being said, inflation expectations have increased over the course of this year. And also, I think the persistence of elevated inflation, even, albeit moderating a little bit, I think will be key. And, as your other guest mentioned, and we mentioned, some of the many sources of inflation, it's still yet to be seen the full impact of those, whether it's the cost of energy, the cost of food, other supply chain issues as well. And so I think it's too early to say that inflation is really, going to moderate back down towards the Fed's target, for example. And so I think, the persistence of inflation, I think, is going to be key going forwards. And it does mean that we're going to continue to see relatively elevated volatility as the market continues to try to get more clarity on that.
All right, so maybe we passed the peak, but we're still going to see inflation remaining at elevated levels, certainly higher than the Fed target. I want to talk more about the dispersion, Amanda, that you bring up, and the volatility, Marilyn, that you mentioned as well. Amanda Lynam, Marilyn Watson, and Troy Gayeski are going to stay with us. Up next, the auction block, U.S. debt issuance remaining on hold ahead of the holiday weekend. That conversation coming up next. This is Bloomberg. I'm Matt Miller in for Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in Europe with a host of sovereign debt deals boosting issuance above trader estimates. Offerings from Italy, France, and Austria pushing weekly volume to roughly 46 billion euros. And in the U.S., high-grade bond sales missing weekly estimates by the widest margin this year. Just one borrower coming to market, raising $500 million ahead of the Memorial Day holiday. And here in the U.S., junk bond market remaining frozen as well. Another week of zero issuance, capping off a month of May with just 2 high-yield debt sales in total for the entire month. Sticking with credit, Allspring's Margie Patel making the case for U.S. junk bonds as they close in on their biggest week of gains in nearly 2 years. Take a listen.
Corporate bonds, especially high yield, I think are really pretty attractive. When you look at high yield bonds yielding 6.5% to 8.5%, trading at 90 cents on the dollar, for a longer term investor, meaning a year or more, that looks like a pretty reasonable risk return alternative.
Amanda Lynam from Goldman, Marilyn Watson from BlackRock, Troy Gayeski from FS, all still with us. And it's interesting, I was talking with Eric Kazatsky from Bloomberg Intelligence earlier about munis, and he was saying there's been a similar level of optimism in the last week after they've, been in the same trouble as everybody else in credit year to date. Does it seem, Troy, like everyone's been getting a lift over the past few sessions?
Oh, 100%. I mean, when you think about what transpired really the first 4 months, that was all about resetting Fed expectations for hiking, higher yields that impacted all duration-bearing assets, including, go growth in the equity markets. And, you've really gotten a respite here the past several weeks. To the point of your prior guest, clearly there's much better value in high yield right now than there was coming into the year, not even close. And there's even better value in CLOs, particularly double Bs, where you have close to 10% yield. Unfortunately, though, we still could have bouts of volatility here the next several quarters. But if you have a 3-year view or at least a 1-year view, you should have a positive total return. That being said, again, I think in times like these where there's so much uncertainty, whether you have an inflationary environment, whether we roll over into a recession, certainly not our base case, where you can focus on things with stable NAV, have some floating rate exposure to benefit from the Fed hiking, like senior secured commercial real estate debt. At our firm, we have a gentleman named Rob Lawrence who does a great job managing that. And we have 123 line items with no delinquencies right now. And we're starting to lend out at higher yields than we were even 6 weeks ago. That's a very viable option right now.
Marilyn, the dire situation in terms of issuance in the U.S. contrasts starkly with what we see in Europe. What do you see that differentiates the two? Is it just about the geopolitical issues?
I don't think it is just the geopolitical issues. I think it's partly because, the Fed is far ahead of the ECB, for example, in terms of actually normalizing rates, raising rates. And obviously, I think the high yield market there is considerably larger as well. And I just think the level of uncertainty in the US, I think we've already seen sort of a lot of volatility there, and the market's continuing to digest that. I think in terms of the Eurozone, then, issuers are trying to get ahead of the market. They realize that the ECB is going to start raising rates soon. They're trying to get ahead in terms of locking in those very, very favorable rates. And so I think you can see the difference there in terms of the two central banks. And I think also when you look at some of the technicals as well, then, obviously there has been limited supply in the US. I think, we're far short of where we were this time last year. I think when you look at beneath the hood a little bit as well, though, there has been more issuance in financials, for example. And so I think there is dispersion among the different sectors that are issuing. But I think, there's a huge amount of dry powder out there. There is a huge amount of cash sitting on the sidelines. Investors want the yield. They need, to get bonds back into their portfolios. They want, the alpha, they want to return yield. But it's just finding the time for what are now relatively attractive valuations. And
they, I guess, increasingly need your help, right, Marilyn? With that kind of dispersion, investors are going to rely more on you, on Troy, on Amanda. Is that good news for the industry?
I think that's very good news for the industry. I think for a prolonged period of time, given the suppression of fixed income markets by the major central banks, then we've just seen this enormous suppression of yields, of spreads. And I think now that we're starting to see, an unwinding of that, and we're starting to see a lot more dispersion, then really this is, it presents a great opportunity for fixed income investors going forward when they can put on relative value trades, when they can take advantage of looking at the fundamentals, the underlying fundamentals from individual issuers, when they can take advantage of different strategies to really try and lock in that alpha. Then I think now, for the first time in actually a very long time, we're starting to see a very, very positive environment for active fixed income investors.
By the way, Amanda, do you expect to see a pickup in issuance? I mean, this is the auction block, so let's talk about whether we'll have anything to talk about next month.
Yeah, for sure. And I totally agree with Marilyn. I mean, we're no longer in this rising tide, lifts all boats environment. And so the importance of active management is critical. On the issuance front, just kind of going back to your earlier question, Matt, on the differentials between the US and Europe, if you were to zoom in on European high yield corporate issuance in both the US and in Europe, and you looked at 2Q year to date in isolation, in both regions, we're actually on par for one of the lightest quarters since late 2018. And we all remember kind of how concerning we were at that point about late cycle risks and imminent recession and fallen angel risks. And really the primary market slowed down considerably then. So both markets are showing a slowdown. Both markets are also showing an uptick in coupons for the few deals that do come to market. If you look at the average coupon in U.S. high yield, it's the highest since the fourth quarter of 2018. If you look at the average coupon in European high yield, it's the highest since the fourth quarter of 2016. And so really what that's reflecting is that you've got a secondary market in those high yield universes where the secondary bonds are trading at significantly low dollar prices relative to the start of the year. So the new par bonds that come to market have to offer a generous new issue concession. So I do think that environment does present somewhat of a risk to the high yield market in both regions as we kind of have new issuance cycle through at wider levels because of those kind of required concessions to encourage investors to step in and buy the par bond when there are low dollar price bonds available in the secondary market. On the IG side, it's been quite active. In the US, we're actually not running that far below versus last year's level, which presents some upside risk to our 1.3 trillion forecast, as we've noted. And similarly, in Europe, we're expecting 525 billion of European IG gross supply this year. The risks to that forecast are also skewed to the upside. I think in high yield, corporates, as we mentioned before, many times have had the luxury of being patient. So I think it's probably more conceivable that the supply in that market will remain somewhat subdued. In IG, I think you always have the potential for kind of opportunistic issuance if we do need it. And we're for sure running slightly ahead of our forecast so far this year.
All right, Amanda Lynam, Marilyn Watson, Troy Gayeski, you're all going to stick with us because still ahead is the final spread. The week ahead featuring a busy slate of Fed speak and U.S. payrolls. That conversation coming up next. This is Bloomberg. I'm Matt Miller in for Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead. Coming up, U.S. markets obviously closed for the Memorial Day holiday on Monday. U.S. consumer confidence, though, kicks off the data coming out on Tuesday. The Fed set to start shrinking its balance sheet on Wednesday. Plus, Fed speak coming from a number of speakers, Williams and Bullard, after Wallace, who actually speaks on Memorial Day, but in Germany. Another round of U.S. jobless claims coming out on Thursday, and finally rounding out the week with the U.S. payrolls report on Friday. So it's an important week for sure. Amanda Lynam from Goldman Sachs, Marilyn Watson from BlackRock, and Troy Gayeski from FS still with us. Probably, I guess, the biggest question mark, which starts next week but won't be answered for a while, is the Fed reducing its balance sheet. Amanda, how big of an impact does this have on your world?
Sure. I mean, it's created some interesting and attractive relative value opportunities for us in the agency MBS market, for example. There had been a lot of concern from some market participants that the Fed might perhaps engage in active sales of agency MBS. That is not our economist base case for the near term, but nonetheless, it did cause some underperformance in agency MBS spreads versus IG corporates. We, a few weeks ago, upgraded agency MBS to overweight versus IG because we saw that as a dislocation that should correct as time goes on. And we also view the consumer as in pretty strong shape. So too are corporates. But when you think about kind of a beta to slowing growth, we think that the agency MBS market offers a more attractive exposure relative to IG corporates going forward. So it's definitely created some opportunities in our world.
All right. Unfortunately, we only have 30 seconds, so I'm going to have to leave it there. But Marilyn Watson, thank you so much for joining us. Troy Gayeski, great to see you. And American Lynam, you got the final word. From New York, that does it from us. Same place, same time next week. And thankfully, John Ferro returns to this chair. This was Bloomberg Real Yield. This is Bloomberg.